Hello, everyone. We have our last, live of the year with Jay Pelosky. So, lots to talk about. Without further ado, it's great, to hand the floor to Jay Pelosky, our great friend. We've done, a lot of work this year, and Jay has had some fantastic calls. He's been with us, since the very beginning of the year, and we look forward to do more next year. So let me hand the floor to Jay, and we'll talk about his last musings, which have kind of an interesting title. So it's contrary to what everybody says. So do we sell the rumor and buy the news? So tell me how does that work, Jay? Exactly.
Yeah, exactly, Roberto. Well, good to be with you, and I certainly have enjoyed these lives over the course of this year. It's been great fun. I think we've covered a lot of ground, and we've had some good calls, and of course, we had some not so good ones. But I think on the whole, we've had a pretty decent year, and let's hope we finish it out on a high note. And that's really kind of what the musings on Friday was all about, right? The old cliche or adage of Wall Street is buy the rumor, sell the news, right? And I flipped it in this musings, entitled The Musings, Sell the Rumor, Buy the News, because it seems to me like that's what this market is doing, right? You have Omicron come out of nowhere the day after Thanksgiving here in the US and spook the heck out of markets. You had the Fed chair, Jay Powell, flip-flop on inflation and its transitory nature. And boom, everyone starts to sell based on rumors about 3 or even 4 rate hikes next year. I mean, every week it seems like the rumor is a more rate hikes, more rate hikes, more rate hikes. And so I think it's actually a little bit crazy. And we've had, you and I have talked about this, and I've called these kind of pullbacks potholes, right? That's been my expression. And as a quick reminder, right, think about driving down the road, you hit a pothole, a hole in the ground, and the car shakes, and you're like, wow, what is that? And then 2 miles down the road, you forget all about it because the road is fine and it was just a pothole. And even here, this market, we hit a new all-time high on the S&P on Friday. And yes, certainly is not as robust as one would like it to be, but the market did have its best week since January. The U.S. market, as represented by the S&P, had its best week since January last week, and the European market also had one of its best weeks of the year. I think the second best week of the year last week, European equity. So today actually is another day where it's like, wow, what drove the selling? I was a little bit surprised by the market action today. And it seems, as I said in my musings, a little bit perverse to me, where you have investors kind of selling the segments of the market that are most exposed to the consensus outlook for next year, which is above average growth and above declining, but above trend inflation. That is the consensus outlook for 2022 in the United States. And the segments that are best exposed to that are the cyclical and value sectors. The ones that are most negatively exposed to that are the tech names. And yet you've seen the selling of the cyclical stuff and the buying and the crowding of into the big cap tech. And so you've had a situation where, while this was seemingly another pothole, the damage done underneath the market has been kind of significant, and is something we're paying close attention to. As you know, at TPW Advisory, we do pay close attention to technical analysis, and that's something that we did note over the last week. There has been some technical damage, but on the whole, you have a situation where reports like Morgan Stanley's Global Risk Demand Index is at a 10-year low. That means the appetite for risk is at a 10-year low. I mean, that's not what happens when bear markets start. That tends to be a pretty good buying opportunity.
Yeah.
And if you look at reports from Goldman, JP Morgan, and others, JP Morgan talking about a violent unwind in the systematic or CTA community, Goldman Sachs talking about significant degrossing in the U.S. long-short hedge fund community. So there's been a lot of action and a lot of people kind of turned upside down But it's important to note one of the things I took away, and this was in the New York Times of all places last week, that each of the COVID-related sell-offs has been in a shorter and shorter time period. So we've now had 4. The Omicron was the 4th one, and it only lasted, at least to date, only lasted a couple of weeks. And so compared to, the first one in the spring of 2020, and then the fall of 2020 and the spring of 2021 with Delta. So this is the 4th one. Each one has been shorter. And much like the markets have kind of understood that these variants are now going to come every once in a while and they're going to scare us. But we have to remember 2 things I think are very important. And then I'll pause. The first is the speed of science, right? And I wrote about this a year and a half ago, almost 2 years ago now, COVID speed. And the speed of science means that it took 1 year to get a COVID vaccine as opposed to the normal 10. Now people, Pfizer and others, talking about the need, if necessary, for a specific Omicron vaccine. It can be ready in less than 3 to 4 months. So from 1 year to 3 months. And by the same token, societies and economies have obviously been able to kind of learn how to function in the midst of COVID. And the poster child there is Europe's Q3 earnings up 60% year on year, even in the midst of a lockdown. So to me, we have to remember as investors that, the speed of science, the speed of markets, discounting these things, again, they're scary to go through, unpleasant to watch the portfolio dwindle in value. But the longer term outlook is, you sell the rumor, you buy the news. And I think, that's what we can maybe talk about next, the pain trade.
Yeah, no, so it still looks like, those are great points. And it still looks like the pain trade is higher, right? So, it seems like, sometimes we have, massive sell-offs, and it would be great, if you could say how the average stock, how the headlines, the benchmarks don't tell the story of the average stocks. But how exactly does that work, for the pain trade to still be, going higher?
Well, I think it really is, thinking about what has been discounted, right? So if you think about Omicron, I think for the most part, unless it turns out to be much more deadly, it's clearly more transmissible. I think that part is pretty well known. We've learned that over the last couple of weeks. It also seems to be more mild, which arguably is kind of a best case outlook, where you have a less dangerous but more transmissible variant, having more people being kind of basically getting it and then being kind of somewhat inoculated against it. Now, obviously, that's not fully baked in yet. We don't have all the definitive answers about Omicron, but it does seem to be the case to date. So that would seem to suggest that Omicron and the fear around that has been effectively discounted. And then you had last week, at the end of the week, you had the great inflation number, which came out pretty much bang on expectations. And the market reaction was, what we saw for the most part, pretty positive. And I think what's really interesting to me is that people don't seem to be understanding or doing the analysis to understand that there's a big mechanical piece in the inflation number, namely the base effect. And I think inflation in November of 2020 was roughly 0.1% month over month. Inflation in November 21, 0.7. So you drop out the 0.1, add in the 0.7, and the headline number goes up. But that's all going to reverse next year. So if you look at the Bloomberg consensus, for example, you'll see that inflation is expected to peak in the United States this month, right now, in December, and fall by more than half by March of next year. So the Bloomberg consensus for U.S. inflation in March of next year is 3 months away, is 3%. So I think that that if the market really starts to understand this, and we'll see what the Fed says in a couple of days. I mean, who doesn't know that the Fed is going to accelerate taper? Who doesn't know that the dot plot is going to have a couple of rate hikes for 2022 on it or in it? The market is already discounted and pricing in effectively 3 rate hikes next year. And some of the, some guys I respect, like Steve Blitz at Lombard, a guy I've known for many, many years, he's now talking about the first rate hike being in March. So I think it's, again, you sell the rumor and you buy the news. And the pain trade, given that we've had, we had sentiment to go from overly bullish. Remember, before Omicron, in the day after Thanksgiving, the S&P had been up 16 of 18 days, right? So we were overbought. And we know how the pothole playbook works. You're overbought, something comes out of nowhere, aggressive selling for 3 or 4 days or a week. Sentiment goes from a headwind to a tailwind. That's where we are now. If you look at retail investor interest through the AAII survey, or if you look at the advisor service bullishness, they're at spring 2020 lows. So again, back to the beginning of COVID is where sentiment is. So that's clearly a positive. Positioning, we talked about it, right? Everyone's degrossed. That's a positive. Seasonality, that's a positive. The history, when you have big down volume days, we had a 90% down volume day. We had a huge VIX spike. The history of these things, 1 month, 3 months, 6 months down the road, is pretty uniformly positive. So I think that there's a lot of people who are quite bearish, and there are a lot of reasons that people are expressing, particularly around Omicron and the Fed. I think a lot of that is discounted, is already in the price. Sentiment, positioning, seasonality all suggest that the next move is higher, and therefore that pain trade is going to be higher because people are not at all prepared for it.
Yeah, no, I just want to make sure, I got the number right, because, you're breaking up a bit. So you said in 3 months' time, the U.S. headline inflation is expected to be at 3%, right?
Correct. Yeah,
and so
correct.
It looks like Friday, was one of those classic cases where, the number was kind of in line with expectations, but it was better than feared. So people feared, something a lot worse. And I mean, it does really look like, we may be at or just, past inflation peak. Is that a view you share?
Well, yeah, as I mentioned, Bloomberg, again, I'm not an economist. I'm a strategist, so I never claimed to be an economist. But Bloomberg Consensus, which polls, 40 or 50 of the best, biggest firms and their economists, they are saying that inflation peaks this month at maybe 6.8. I forget what the number was on Friday, 6.7 or something like that. So effectively the same, and then drops off sharply because these base effects. Because the numbers in the beginning of 2021 were much higher than 2020, obviously, given 2020 was, the year COVID kind of struck. And so the numbers by definition go down considerably. And that's why every firm pretty much has the same kind of peak and then sharp decline in inflation. And I think the Fed was hoping to get through these couple of months, because that's the transitory nature that they expect and we're talking about. But I think the political pressure and the supply chain issues and some of the energy price concerns, all of that stuff bubbled up very quickly and kind of, I think, politically made it unpalatable for the Fed to stick with its transitory inflation. But for me, the big thing, my point is that the big risk out there, everybody's big risk, is that the Fed is going to be overly aggressive. And that's what happened in 2018. And that's what happens every time the economy rolls over and every time a bull market ends. It's because the Fed ends it. And my point is that when we get to the spring of next year, I'm fully on board with the idea of accelerating tapering. No problem with ending it in March and having more time to decide what to do between end of taper and beginning of rate hikes. I just think, in part because we'll see the situation where this base effect will mean that inflation is going to be higher than the average of the last 10 years, which is about 2%, 1.5% to 2%. It's going to be much less than 6%. It's probably going to be somewhere in the 3% range. And you know that I've been talking about this for months and months, right?
Yeah.
Above average growth and above trend inflation is an environment that we should really welcome as investors, because that's an environment where companies can make money. That's an environment where margins can be maintained. That's an environment where people can make more money. And so I think that's where we're going. But that's not, when people think about the big risk, they think about an overly aggressive Fed. I think this mechanical effect plus the fact that supply chains are getting better, plus the fact that energy prices have come down, sharply, right? We had oil down 6 weeks in a row until last week. So a lot of that stuff that created the concern a month or two ago has already somewhat unwound, and I think will continue to unwind. You recall that a big part of my thesis for next year is this idea of Asian reopening leading to a synchronized global expansion. Everything that's happening that's coming out of Asia supports that. The most recent thing was just this morning was Korea's exports. Korea's always looked at the first 10 or 12 days of the month, their trade numbers come out, and that's what people focus on to get an early read. And they were very strong. Exports up, I think, 20% year on year, better than expected. So that Asian reopening is happening. We're probably going to go, and now you're seeing reports on Bloomberg of likely sharp markdowns in prices once the holidays are over, because there's going to be so much stuff that's getting unloaded from the ships and is going to be hitting the shelves, and it's all going to have to be marked down.
Yeah.
So marked down is not inflationary. It's the opposite of inflation.
It's normally not, yeah.
So I think that I think volatility is going to be a big issue in fixed income next year. I continue to think that maybe two rate hikes at the most. I do think the Fed is going to want to have a little bit of time in between ending taper and starting rate hikes, particularly if the direction of inflation is down sharply from, let's call it, near 7% in December to 3% in March or April. I think the Fed's going to want to have a month or two to watch that and see how things play out and get a feel for labor. Because I do think the whole issue of, inflation expectations getting built into wage demand, creating kind of a self-feeding mechanism is probably one of the big things the Fed is worried about, and therefore will want some time to watch it. But to me, the big risk of an overly aggressive Fed fails to take into account this idea of a sharp deceleration of inflation kind of simply through the base effect.
No, so this it's great to hear, because if there, I mean, and it's funny because we're just discussing before we went live, and you said, I mean, it's absurd, to think that one death in the UK could spark a 1% sell-off in the US market. But funny or not, I mean, it's what the Brazilian headlines are saying. Valor Econômico, the main financial newspaper, is saying that this, I mean, of course, other than anxiety about the Fed, is what has spooked the markets. And if there is so much anxiety, it means that the market, there should be a relief rally, unless there is a hawkish surprise with the Fed. But it doesn't look like that's something they want to do, right?
Well, not only do they not want to do it, again, the market has already discounted the hawkishness. The market is already pricing in 3 rate hikes next year. It's already pricing in the possibility of a 4th. Already talking about rate hikes in March. So, I mean, I really struggle to see how it's going to be more hawkish than 4 rate hikes starting in March. I mean, if that happens, I think that's going to be a problem. I don't think it's going to happen, in part because of the things we just talked about. But look, some of the stuff that we need to think about is what's not discounted, right? And one of the things that's not discounted is a strong U.S. Q4 growth number. And the Atlanta Fed, which you may be familiar with, does a nowcast. So it's real time model of the expected growth rate for the current quarter, and that, as of last week, was at over 9%. So 9% real growth in Q4 plus 6% inflation is roughly 15% nominal GDP growth. So what do you think that means for earnings? Earnings are going to probably be very, very strong. And if you have very strong earnings, which will come out in the early part of January, and you have continued really negative yields, real yields, which is the case and is likely to continue to be the case, I look at those two things, solid earnings growth and negative real rates, as kind of the real support for risk assets. And I struggle to see how a big decline is going to manifest with those two things being in place. And you have a situation where the S&P today trades at roughly 19 times forward earnings. It's cheaper than it was at the beginning of this year. And you have GDP growth, for example, pre-COVID, you had the market trading at 19 times earnings. Two differences, though. GDP was roughly a third of what it is today, and the 10-year yielded 50 to 60 basis points more than it does today. So you had a you had a higher yield, you had slower growth, and the market was trading at the same 19 times earnings. So to me, I think there's a fair bit of stuff on the positive side of the ledger that market participants and certainly the media are not really focusing on. You can hear all you want about it. It's amazing how many inflation stories you can read without any talk of the base effect. It's just amazing to me, without any talk of the Bloomberg consensus being at 3% by March of next year, 3 months away, 3 months from today. I mean, it's crazy to me.
Yeah, this is amazing because I just read an article today. I mean, I just saw the title, just saw the headline, and saying that Bloomberg is I mean, there was an article on Bloomberg suggesting that American families spend their salary right at the beginning. I mean, right as they received, which is a way to escape inflation. So I mean, I guess this tells about the paranoia that people have about inflation, and it looks like it should be going away, especially because at least the next headline numbers should come better. I mean, unless we see oil back at $80, correct?
Yeah, I mean, again, we've gone through it a couple times. I mean, the consensus is for inflation to be cut in half between December and March, the next 3 to 4 months. And I think that the last thing I just want to make one more point about earnings, and then maybe we can talk a little bit about some of the changes we've made to our models last week. But the Morgan Stanley had reported very strong earnings revisions, well above historical averages for Q4 and for 2022. So there's a 20-year average for the out estimate. Okay, so the out year estimate, so forward earnings expectations, the 20-year average for the out year is minus 3%. Right now, for the out year, which is 2022, it's 14% positive. So I think people are really missing the boat on what is a very strong earnings environment. Again, I'll go back to the point I made a few minutes ago, 15% nominal GDP growth in this quarter for the US, 15%. Before COVID, we were at nominal growth of under 5%. 2% growth, 2% give or take inflation. We're in a very different environment, and yet the market is priced the same. That's not excessively expensive. That's, again, you pick up so many articles about super expensive market, no matter how you look at it. I mean, there's obviously, blood sells. The old newspaper adage, right? Blood sells. Lead with the blood.
No, totally. And no, I fully agree. There is a complete hysteria about inflation, and we already talked about this. So why don't we cover now the changes to the model portfolio?
Sure. Yeah. No. I mean, as you remember, and as the folks in the audience, live audience, will remember, we do our monthly at TPW advisory at the end of the month.
Yep.
That allows us to collect all our thinking. We update our tripolar world. We update our global risk nexus. We look at the technicals of all our positions in the two models. Remember, we have the global multi-asset model, and we have our TPW 20, which is 100% thematic. We go through all the technicals. We look at some quantitative analysis, and then we make our changes. and clients of the model portfolio delivery service get those updated models, get a letter from me, and we have a conversation, and that's all part of the service. So I obviously can't go into all the details here, but certainly I can say the big change for us was really reaffirming and kind of honing in on our view that China is going to be one of the best performing markets in the world next year. And this is a pretty contrarian point of view, but I'm really firmly of the view that next year will be a glide year, a glide path year for China. And I'm calling it China 2022 glide path, meaning that the path is set and we're going to just go quite smoothly through the year. It's the year, at the end of the year, a year from now, President Xi is likely to be given his third term in office, the first time in decades for a Chinese leader to have that opportunity. And I highly doubt that there's going to be major difficulties in China in that run-up to that event. And we've had, even just over the weekend, the Politburo coming out and saying stability is the top priority. We had the central working group for the Politburo on the economy talk about, just today, came out in the press today, front-loading policy measures to sustain real economic activity. So China, as I've said before, has a full policy quiver, right? Their interest rates are significantly above that of the US or Europe. They did not use fiscal stimulus. They have every capacity to use fiscal stimulus should they decide they need to. We have seen the PBOC cut the reserve rate requirement for the second time this year, last week. That's the beginning of the move. You're starting to see near-term indicators suggest that the credit impulse in China is picking up. You have bombed out markets where you've had every opportunity to sell, going back to August with the edicts on antitrust and on tutoring and on social equality. You had the Evergrande saga, remember, which was going to bring down the world. Of course, did nothing of the sort. You had the energy price issues with coal. You had supply chain concerns, et cetera, et cetera. So you have a market that's been very oversold. People have had every reason to sell, have sold. You have a glide path political environment. You have a full policy quiver. You have a very solid currency. So we really went and added and initiated, in some cases, positions across equity, government debt, credit, high yield, across the board in China. I think it's going to be one of the best performing markets in the world next year.
Mm-hmm. No, I agree. And one interesting thing is, you kind of touched on it already, but the events over the weekend, as you said. So there was the Evergrande default, and it doesn't seem like there was any frenzy or market collapse over it. It was another home builder. So it looks like they're stabilizing the real estate market, and that seems to be critical for China. The Olympics will happen, and the simple fact that we haven't heard more noise on the steel production and so forth. Iron ore markets are still recovering. So, is there something that you have heard over the last few days that confirms the view, or should we expect more news once the Olympics are out of the way?
Well, I think you're going to continue to get news out of China as we get news everywhere. I just make the point that for all that bad news, the best performing major equity market in the world over the past 1 month was China. Okay,
Yeah.
Best performing major market in the world was China. Again, you don't read that anywhere. Nobody talks about it. Everybody talks about China's a mess, geopolitical concerns, invading Taiwan, all this stuff about Evergrande and all the rest of it. It's an opportunity for people to look beyond the headlines and do some research and do some analysis. And to me, they're making it very clear. They've got the major issues out of the way in the fall of 2021. So policy-wise, there's not going to be any, I don't think, any big further shocks. You have that policy quiver. You have no inflationary concerns in China. China inflation came out late last week, 2%. So no inflation concerns. Currency is completely rock solid. It's actually been one of the strongest currencies in the world, actually appreciated against the dollar year to date. No problem with the strong currency because the trade surplus has been a rock star. Probably, I think it's the second best trade surplus in the last 20 years for China. So no, so if the currency weakens a little bit, no problem, no inflationary concerns. They don't need to weaken the currency to sell more because that's not their approach. Their approach is developing domestic demand, not exports and not infrastructure. So I think people have kind of misread China. And to me, in this environment where there's a lot of uncertainty in the U.S., indexes are at highs, you want to look around for laggards, right? You want to look at things that have already been beaten up. And I think certainly from a big country perspective, in terms of asset allocation, again, across debt, equity, and currency, we're taking positions across all of them in our global multi-asset model portfolio. China really stands out to me as a laggard that looks like it's very well set up for outperformance next year in 2022. And so I think that's really interesting. I continue to think Japan is very interesting. We continue to talk about Japan as a place, a real area of opportunity. Again, a big laggard, cyclical market, cheap market, a market that's going to grow close to 3% next year. Growth in Japan this year and next, as in Europe this year and next, are going to be like two of the best back-to-back years for growth in these countries that have been seen in a decade or more. And the market's not pricing any of that. Japan will unveil a big fiscal stimulus here in the next couple of weeks. Europe's next gen program, as we've talked about, is dispersing funds. The bulk of those monies get dispersed 22, 23, 24. So I think the world, as I wrote about in my monthly last 2 weeks ago now, the tripolar world in an age of speed, the opportunity set is to look beyond the US and look at what's happening in Europe and in Asia and position accordingly. And I think that what's interesting to me is that the short term and the longer term. So the short term is, an oversold China. The short term is a laggard Japan. The longer term is the development of the regional integration process in Asia and in Europe. The two of them are pointing in the same direction, which is namely, you should have a portfolio with some exposure to all these regions. And I think that's one of the things we really tried to achieve a little bit with our model updates this month.
And with regards, to the, other updates in the model, you talked about regions, so China, Europe, Japan, pretty constructive there. Can you talk about, in the US? You've been talking about, technology rolling over. So is that still the case? And within the value portion, would it be mostly banks or materials?
Yeah, it's all of the above. We continue to hold those views. Overweight equities in a global multi-asset. We're overweight equities, deeply underweight bonds, overweight commodities. In the U.S., we are overweight cyclical and value. All the segments that you mentioned. We do think that the charts are looking really quite good for some of the material stocks that stood out to us when we did our technical work over the last week or so. As I mentioned in my musings, there was some technical damage in some areas, but there were also other areas where support held and ETFs bounced quite nicely off important support levels. And I think that's in this market where there's so much uncertainty and so much of things that we haven't really seen much before, like COVID. Technical analysis, I think, can really be a value add to entry and exit points So yeah, those views continue. And in regards to technology, I continue to think, and I mentioned it earlier, there's going to be interest rate volatility, and notwithstanding inflation going from 6 to 3% next year or so, give or take, I do expect the 10-year U.S. Treasury bond to yield close to 2% by the middle of next year. And so if that works out, then I think the big cap tech, and this is what is perverse to me, the big cap tech, which is where everyone is kind of crowded into, and the crowding's only gotten more intense. And again, this is the stuff that you read from Goldman and Morgan Stanley, the guys who have real insight into this through the prime brokerage arms. The crowding has only gotten more intense. You look at Apple's spike. That's an example of the crowding into these names. Those names are going to be exposed if we have an interest rate environment like I think we're going to have. If we have an above average growth and declining but above trend inflationary environment in 2022 and 2023, I don't think that's going to be a good environment for technology. As we've talked about, technology is already underperforming versus the cyclical stuff. If you look at XLE, for example, the energy stocks versus XLK over the last year, guess what? XLE has massively outperformed XLK. Now, again, that's not what you read in the papers. That's not what you hear on Bloomberg, but that's the reality. It's already happening. And so I think it's going to continue to happen. And that crowding, as I said, is perverse to me. I don't really get why that is. I mean, I get it in one sense. It's safety. That's where the growth is right now. That's where everybody is. I'm not going to get fired holding Apple. I get that. But, if you're looking beyond the next couple of days or weeks, looking out into next year and beyond, I mean, I think it's important to maybe take a step back and talk a little bit about not just 2022, but, 2023, 24, 25. I think there's a very good case that we are entering a period that's very similar to the second half of the 1990s, which was the last time the U.S. had a capex boom and a productivity surge that led to several years of above average growth with limited inflation. And that included a period of time when wage growth was really quite significant. It's really the last time we had that kind of setup. And I think the current setup is very similar to that. We're going to have a capex boom. You can already see it building in the numbers. You have, companies are cash rich. It's the cheapest to borrow as it's been, and God knows when, maybe 100 years. You have climate mitigation that needs to take place. We just suffered another horrible series of tornadoes through,
I did see
the
that
south of the United States. Climate mitigation, infrastructure build out. I do think President Biden's going to make a push to get the second leg of his infrastructure plan passed in the Senate before the end of the year. So there's going to be a lot of focus on that. And at the same time, you have the productivity surge, that speed of science, that analytical speed, the stuff that I've been talking about, marrying the tripolar world with the age of speed. I think that's the kind of thinking we need to be doing as investors, thinking about what are the implications of that. And so I think that there's a real opportunity for that kind of a second half of 95, from 95 to 99. That's the analog as I see it. And that to me means there's some real opportunities in the thematic space. Thematic is something that we believe in as a real opportunity set for global macro investors, which I consider myself one. And thematics have been punished in lots of cases. You get the quote about Kathy Woods of ARK, the poster woman for thematic, saying how she's been shaken by market activity. Is that bearish or bullish? I think it's probably bullish because look, she's been hit, and so to me that's where you should be looking for opportunities. And so we continue to really like the climate space. We continue to really like some of the other segments. Some of that stuff we were able to add to. Some of it we took some profits on. We've talked very positively about carbon. KRBN.
Yeah, that's what I was going to mention, and you actually nailed it because on the day that I tweeted, I think it was Ben Laidler's article, and then you said it looks a bit overbought. I think it was Thursday of last week.
Yes, exactly
and then
right.
it was down like 7 or 8% on that day.
Yep.
Recovered a bit, so but it's still above 50. It was a bad day today. So what you said now, we kind of anticipated 3 questions that I've had. One was, what changes, if any, have you made to the thematic portfolios? So, and then I'll go over the other 2. So let's address that, and then I'll bring the other 2.
You'll get the others. Yeah, exactly. No, it's that kind of market, right? You got to have like all sorts of lists to remember what you're supposed to be thinking about. Yeah, we did actually trim KRBN the first time since we put it in the portfolio. Basically, just as you guessed, it was very overbought. And you're absolutely right. I mean, you mentioned me on that Twitter, and I wanted to convey to people that, hey, I would be very careful. I think that day the RSI was close to 85. You do not want to be buying stuff when the RSI 14 or 20-day RSI is at 80 or above. And yeah, lo and behold, boom, it gets whacked the next day and the day after, and there you go. So took little profits there, moved a few other things around. I mean, I really can't give too many details because it really is reserved for clients of the model portfolio delivery service. And hey, we welcome more clients. So if you're interested, reach out and become a client of the model portfolio delivery service. But suffice it to say, in essence, I think the thematic space has been beaten up pretty badly. There's some areas of opportunity there. I think China is very compelling. Like Japan, as we've talked about, continue to like Europe. I mean, you look at EUFN has been sold back down now under $19.50. I think that's a screaming opportunity. The banks are in very good shape in Europe and should do very, very well in the environment that we're talking about. Europe is going to grow.
Before I forget, let me just point out, talking about UFN, I don't know if you saw, but UniCredit, the biggest bank in Italy.
I did, and it got no reaction whatsoever.
Oh, the dividend yield, yeah, it's going to be like 50%. You got 40% until 2024. So I mean.
Yeah, but and UniCredit is one of the big holdings in the UFN, and it did absolutely nothing.
Yeah.
This and it went down. This is what I'm talking about. People just are not paying attention. They just they hear big case counts in the UK and they worry about Europe and they sell. They don't think about the fact that European earnings were up 60% in Q3 year over year. They don't think about the fact that Europe is going to grow 4% next year, most likely faster than the United States. They don't talk. It's just I mean, it is, it makes you wonder if you're not missing something. I mean, I spend a lot of my time trying to think about what am I missing, and I try to read as my
that's how we do it.
Yeah, my old colleague at Morgan Stanley, Barton Biggs, used to always do. He'd spend more time trying to read people who had different points of view than people who had his view or agreed with him. And I try to do the same. I think that's really good work, but it does some of the moves in the markets. I think you have to, if you have a long-term point of view, and we pride ourselves at TPW Advisory on having a long-term point of view. We're not traders, we're investors, we're thematic investors, and we have a perspective through our tripolar world and our global risk nexus work that, allow us to have fairly strong conviction. And sometimes that means you've got to ride through some unpleasantness. And the last couple of weeks were reasonably unpleasant. But going forward, as I said, I mean, I think we're going to get the Fed in a day or two. I highly doubt it's going to be any more hawkish than is already in the price. And I think that sets up the opportunity for the Santa Claus rally into the end of the year, the pain trade being higher. And that in turn allows one to start thinking about earnings, Q4 earnings, which I think are going to be very strong based on that nominal GDP figure we talked about. And so you have a situation where I think the opportunity set becomes more visible. I think you're also going to have China policy action, which will be seen as very constructive early next year. Again, we're just taking the view of the central working group saying they want to front load policy to support growth. Front load means in the next couple months. So as opposed to hearing about decelerating, weakening China, et cetera, we're going to hear about positive policy moves to support growth in China in that glide path year that I expect to see 2022 as it materializes. People are going to start to come back into China. So right now, as I look at it, short term, you have sentiment has become a tailwind. Positioning has become a tailwind. Seasonality has become a tailwind. So in the near term, I think the direction is higher. And then medium term, again, above average growth, above trend inflation, good earnings growth, negative real rates. I think that suggests you want to stay long equities, you want to stay long commodities, you want to be very careful with bonds. And then I think the out-year outlook, as I mentioned, 22 to 25, I think could be much better than people expect. And that view is not at all priced into the markets. The markets are pricing in a return to the 2010 to 2020 period.
Yeah.
Subpar growth, low inflation, not much happening. That's what's being priced into markets. I think that's where the surprise is going to be, that we have the opportunity to really break out of that low inflation, low growth path to a higher growth path. And that through productivity surge, helped by technology in this age of speed and analytical speed that I'm talking about, allows us to have that better, higher growth path without a lot of inflation. And that is an environment that I think, as a long-term investor, you should at least be thinking about. You may not have to buy it, you may not want to invest in it fully, but you should really be thinking about the upside. As you pointed out, Roberto, not just, we're constantly talking about the downside. The upside is something that's not priced into markets at all.
Yeah, that was actually one of the questions. So, I mean, what could go right next year or next years? But I guess we talked a lot about it. So,
yeah, I think we covered that.
It's productivity investments and that accelerating growth, and of course, that does not seem to be priced in. But talking about the investments that will lead to the increase in productivity. Can you update us on the Biden plan? I mean, on the second leg of his Congress agenda, and how it's going?
Well, I mean, there hasn't really been a whole lot. Congress was, on break with Thanksgiving, et cetera.
Yeah.
But I do think that what I've read over the last couple of days and over the weekend is that he does plan to make a push. I mean, part of the issue, obviously, is with inflation, spending more money. It's kind of an easy target for political hit, hatchet jobs by the opposing party saying, why are we spending more money in an inflationary period, just going to make it worse? So there is a little bit of the optics, and that's why I think they wanted to get this inflation number out of the way, get Powell re-up for his second term, get the inflation number out of the way. And then I think the pivot is going to be to try and bring Senator Manchin. I think it's still, for the most part, one senator who is really slowing this process down. And, that speaks to the gridlock of the American political system, which I think, as I wrote, and I spent a fair bit of time on this in my monthly, the political gridlock that the U.S. is facing is something that it maybe could have afforded during the unipolar moment in the 90s and early 2000s when America was clearly the dominant power. But that's no longer the case. You hear all the time coming out of Europe the need for strategic autonomy, the need for sovereignty in Europe. You have very clearly a political system in China that is very different, is much more centralized, and is making the case as to why it is a credible alternative to the American model. And the American model does not look great, given how poorly we've handled COVID and this political situation where one senator can basically hold up an entire government program because it's the Senate is 50-50. We're completely split down the middle. And so, we'll see how it plays out. At this point, I would expect it gets passed. Again, to me, it's the Democrats are negotiating with themselves. They have within the party the capacity to pass this bill without any Republican support, and yet it hasn't happened yet. And that is just speaks to paralysis, to gridlock, to lack of forward thinking and movement at a time when the other regions are moving very aggressively. And I think this is also true, when we talk about not just the US, but the Americas. So it's Asia, Europe, and the Americas. So it's also true in South and Central America. I mean, if you look at the region as a whole, political leadership is not a strong suit, really, almost anywhere in the entire hemisphere, and that's a problem when you're competing. As I argue, we are competing now increasingly as regional blocks, not as individual countries, and not as one global system. That regional integration, that tripolar world of Asia, Europe, and the Americas is what's manifesting itself. And the Americas have a great opportunity to work together to create a hemispheric free trade agreement, to really leverage the desire to have production in each region, as opposed to all being in Asia and then having to send it 3,000 miles back to the United States or to Brazil or to Mexico. So there's a lot going in the direction of regional integration. As I wrote, I encourage people to read that monthly. I think it was really, covered a lot of ground. But the gridlock that we see in the U.S. politically is really A, disappointing as an American, and B, I think it's strategically, geopolitically, very negative for the United States and for the region as a whole.
Yeah, this is not something we've talked about, but I mean, when you talking about geopolitics, when you talk to your investors and to the lots of people you talk to, there's a situation in Ukraine with Russia, and the whole geopolitical space in Eurasia. Is that something that concerns your investor base? I mean, and the people you talk to, because that seems to be making a lot of headlines.
Yes, I think it is an issue for people. I mean, China, Taiwan, Russia, Ukraine definitely are flashpoints that people talk about. Personally, I don't think either one is going to materialize in any kind of shooting war. But nonetheless, it's certainly, one of the things that we've noted is that Russia over the last 2 months is not trading on energy prices. It's trading away from energy, which suggests that this fear of conflict is a big driver to the price of Russian assets. I think that's quite clear, and again, is what we've noticed in our work, our technical analysis, and doing some correlation analysis with oil prices and the different energy pieces we have in the model. So I think that's the case, and people are concerned, and we'll see how it plays out. But to me, it's countries on kind of the periphery of the regions are where the tension really is.
Yeah.
And I would put Russia certainly as a kind of on the periphery of Europe, at least as I think about Europe with the EU. That's a tension point. And similarly, I mean, obviously Taiwan is part of Asia, but the issue of Greater China and that relationship there is one of tension that I think is going to continue to be a tense relationship. But I highly doubt, again, certainly not in the next year, given the focus on making sure President Xi gets his third term. Excuse me. I think it's highly, highly unlikely that there's going to be conflict with Taiwan.
Mm-hmm. No, I agree. So, we're very close to the end. What I would suggest, what I would ask is if you could, wrap up and kind of, give a year. I mean, given this is the last time we meet this year, give kind of, a year-end message. I mean, we already talked about your calls for next year. for
Yeah.
next year, but kind of mixing the year in retrospect, and I think in your case it's easier because you got most of the calls right, and kind of summarizing what to expect next year, or what to look forward to next year. But I think overall it's going to be a positive message.
Yeah, I want to be positive. I mean, I think we talked in the very early part of this year, or you go back to my 2021 outlook, I called for a golden age of asset allocation. I think that certainly manifested. We had the worst year in
Yeah.
fixed income that we've had since the 1940s. We had the best year in commodities we've had in quite a considerable period of time. We had cyclicals outperforming technology in the United States. As we talked about, we had thematics working very well with things like KRB and LIT and URNM and others. So I think all that worked out pretty well. I think looking
Well,
into
also energy. When you talk about new and old energy,
old and
you made
new.
it very clear, and that did work well.
Yep, and I think it continues to hold.
Yeah.
We still have XLE, we still have KRBN, we still have URNM in our model, and so as I said before, we tend to be longer term thematic investors with the framework that we have laid out that we try to follow and try not in these pothole markets to get shaken out. I would say looking into 2022 that continues to be our approach. We don't want to be shaken out in these pothole markets. We do think we're going to have very solid earnings growth. We do think we're going to have continued negative real yields. We do think as a positive, we're going to have China policy action in 2022, which we did not have in 2021. We are going to move from, remember the transitions we talked about. We are moving from a COVID focus, I think, to less of a COVID focus. Hopefully Omicron doesn't prove me wrong, but I think we are moving away from COVID as the be-all and end-all focus. I think we're moving, we continue to be in an age of climate. Climate is the single biggest macro theme of the 2020s, in my view. And we continue to be focused on transitions within the financial markets, the transition from liquidity-driven to earnings-driven, right? The transition from growth to cyclical value, and the transition from a bull market, a 40-year bull market in U.S. Treasuries, to a bear market. Those are the transitions we're looking at and watching carefully and are positioning for. And so I think that, hopefully we can continue to do these lives, and you can continue to follow me at Ohm Research. And if you want to learn more, the opportunity is there to become a client on the model portfolio delivery service. And we welcome that opportunity. We think both the global multi-asset model and our TPW20 thematic model are things that are differentiated vis-a-vis the marketplace and come with a lot of personal engagement with me that I think you would welcome and enjoy, and I would certainly welcome. So I guess the last thing I'd say, trying to be a salesperson, Roberto, is, I look forward to deeper relationships in 2022 with Ohm, with yourself, with Ohm Research, and with investors in Brazil and in South America.
Yeah, likewise, Jay. I want to thank you for the partnership, and we'll do a lot more. We'll strengthen it in 2022. I want to reinforce what you just said. Personally, this is again a personal recommendation to investors, to potential investors, to engage more with Jay. I've witnessed how his calls have worked in 2021, most of them, and at least the important ones where most of the money was there to be made. So why don't engage more with him and have a chance to look at his model portfolios and his advice on how to construct the portfolios. Most both on the thematic one and the traditional one. So, and I also want to thank you, take the opportunity to thank all of our clients, especially the ones that have been with us every other Monday at 4:30 US on Monday. So and look forward to resume again early January. So I want to wish the viewers of this live, Merry Christmas, Happy Holidays, and all the best in 2021, in 2022, and especially to you, Jay. Thanks again, and look forward to a greater 2022.
Thanks, Roberto. I completely agree. Happy holidays to all, and good luck next year.
Thank you. Good luck, sir.